So what does it mean for a business to go through the liquidation process?
Yeah,
Share
cool.
it with us like we're five.
So I think, well, we're going to talk a little bit about what liquidation.
Okay,
Well,
yep.
just,
What
I
is
guess,
a
to give a bit of
liquidation?
context before getting into the details. So,
Thank you.
look, I thought I'd just expand just on the insolvency terminology generally, because if I talk about liquidation, people might not connect it with what they think liquidation is. So I guess receivership's a word people hear a lot. That's just where the bank appoints someone like us to a company to recover the bank's money. Now, basically, since the against the 60 Minutes show about 5 years ago, where there was a receiver out on someone's farm and ANZ looked terrible and receivers looked terrible, the bank's had a real PR focus, and they've really wound down their receiverships, and they're working with clients to try and help them sort out their situations now. So the next option after receivership, there's administration, and that's really for businesses looking to keep trading. That's what you read about. The big retail brands, Virgin is in administration, and that's really a process. Generally, it's quick, 5 weeks, but it can be longer for bigger companies, and that allows them some breathing space to consider, can they restructure their debt? Can they stabilize their business with the current owners? Or do they actually need to just find a buyer for it? And that's what's happened with Virgin. They've traded it on to the extent that they can to find someone out there that can come in, has enough money to recapitalise it and take it into the future. So if they don't sell it, something called a deed of company arrangement is basically a deal with the company's creditors to say, hey, can't pay you everything. If we go into liquidation, you might get nothing or a couple of cents in the dollar. But here in the middle, we want to do a deal where we pay you 20 to 50 cents in the dollar over a year, 2 years, or it could be a big lump sum if they go and get new finance. Do that deal to say, hey, it's in everyone's interest to keep going. If you take a bit of a haircut, we'll do what we can to pay you more than you'd get in the worst case scenario. So that's administration and deed of company arrangement. And then liquidation is really, for a company that's insolvent, administration can be quite expensive. And so a lot of small businesses, I think 98% of businesses are less than 2 million turnover. They might not be able to afford the fees for an administration, which can be 40 to 100 grand for a month or two of work. So that's where liquidation is really the option for them to hand over control to someone like me that knows the lay of the land, can do it legally, wrap it up, deal with the creditors, so the director's not there getting hounded by people chasing money. I sell the assets if there are any. I investigate what happened with the company's affairs. I do a report to ASIC, and I tell creditors. So it really takes the responsibility off the directors, so that hopefully they can move on and do something new. And if they do want to keep their business going, then they can always buy the assets back from the liquidator or the business. So there is always an option there to kind of keep going. Now, outside of those 3 formal insolvency appointments that you often see, there's really, I'll just talk about that, I guess, the informal space, we call it, where I'm not appointed in a formal capacity, but I might be engaged to advise people. And they're really a turnaround where that's just turning around the profitability, managing cash flow, might be involving finance and ATO debt negotiation. There's safe harbour protection. And it's been around for a couple of years now, and it's what the government has mandated over the last 3 months and up until about the 25th of September to say, hey, directors are protected from insolvent trading or personal liability for their company's debts if their company's insolvent. So at the moment, until 25 September, directors incurring debts that their company can't pay, they're technically not going to be liable, but after 25 September, it returns to normal, and directors do become personally liable for company debts if it does turn out their company is insolvent, which means it can't pay its debts as and when they fall due. It's pretty basic, because there's a lot of companies sort of in that situation. And so what Safe Harbour does is says, okay, well, actually, if you tick these boxes, you're paying your employees, you're lodging your ATO returns, and you can satisfy a test that it's called a better outcome test, that trading on will be better than closing down today, then you can be protected from insolvent trading liability. Now, applies to bigger companies where they've got hundreds of $1 million of turnover, and a director doesn't want to make his personal assets potentially be available for his massive company's liabilities, but it can be relevant for small to medium enterprise as well. And then the last thing, and the turnaround safe harbour, restructuring, and look, that can refer to restructuring a company's capital structure, getting new finance or an investor, and rescheduling its debt to give it a strong base. But it also commonly refers to, I guess, in the industry as a related party sale of business. So that can be a director with a company that's insolvent, selling the business and assets out to another company that he's also the director of. Now, it's very attractive, and it's grown in popularity in the last 5 to 10 years because there's minimal disruption to the business. The director controls the timing and the process, and they just get a valuation, hopefully, and sell it. But the serious risk there is if they do it incorrectly, not for fair value or not on commercial terms, and possibly with their accountant's advice or someone else, then that could potentially be an illegal Phoenix transaction. And that's, we've probably read an article or two here or there where ASIC are really heavy on that, and even I'm nervous about where I see those things that I want to report everything I can to the to ASIC. So good option outside of an insolvency appointment. The company would then go into liquidation though after selling its business and assets, and that's where a liquidator would look at what's happened to the company's affairs and whether the director's done the right thing and whether any advisors have been involved. So I guess, it's a long answer to what is liquidation, but I think giving the full context is probably more help to people than just talking about what liquidation is. Because look, no one comes to me and says, I want to do a liquidation. It's like going to the doctor and going, I want to talk about death. You want to talk about the alternatives. You want to talk about, surviving. So